Hello, my name is Bryan Minogue, and in this video, I'm going to walk through my preferred retirement planning strategy, a risk-based guardrails framework. What I like most about this strategy is it takes a highly customized analysis of your retirement plan and then allows us to proactively walk through some potential negative scenarios that would warrant a change and call out ahead of time the changes you would make to correct course if need be. One of the most frightening aspects of a retirement plan is the uncertainty and a feeling of a lack of control. While we cannot eliminate uncertainty, we can walk through those negative scenarios and focus on what you could control to correct course. Retirement withdrawal strategies are often framed in terms of a sustainable withdrawal rate. A common question I get is, how much can I take from my investment portfolio? But most retirees are not planning to withdraw the same inflation-adjusted amount each year. Unfortunately, that's a key assumption underlying the commonly cited 4% rule, and it rarely matches reality. Retiree income and spending patterns shift. Many retirement plans assume greater spending and/or portfolio withdrawals in the early years of retirement that eventually taper off. So a retiree may plan to withdraw 6%, 8%, or even 12% a year for the early years of retirement before withdrawal rates taper off to 3% or lower. These may still be very viable plans, but would obviously be outside the bounds of a set withdrawal rate strategy. Some common scenarios that would lead to higher withdrawal rates early on in retirement include retiring before Medicare age and incurring greater medical expenses before age 65, delaying Social Security to receive the higher lifetime benefit, or planning to travel extensively in the first 5 to 10 years of a retirement. A Monte Carlo simulation is an excellent tool to account for these retiree-specific scenarios and evaluate whether a retirement plan is likely to be sustainable. A Monte Carlo simulation can factor in these varying cash flows and withdrawal needs, run the assumptions through many different market and inflation scenarios, and ultimately provide a probability of success figure to give you a sense of the likely viability of your plan. So a Monte Carlo analysis is a baseline for our retirement planning, and the output looks something like this. The probability of success figure reflects the percentage of the 1,000 scenarios evaluated where you did not run out of money by the end of your plan, while the median ending asset value reflects the ending value of your assets in the middle of the road or rank-ordered 500 scenario evaluated. While we've been conditioned to shoot for an A grade and anything less than 100% may at first glance seem too risky for your retirement, that's not what we are shooting for in our Monte Carlo result. Something closer to 80% is a great starting point for a probability of success result. And based on your personal preferences and flexibility, your desired starting point may be higher or lower. The Monte Carlo result could be reframed from a probability of success figure to a probability of needing an adjustment by inverting that probability of success. So an 80% probability of success could be thought of loosely as a 20% chance of needing to adjust something in the future. If you want to precisely maintain the lifestyle you've outlined in your initial plan's assumptions, or if you don't have a lot of excess baked into the plan that you would be willing or able to cut, or if you desire leaving a significant legacy for your heirs, then a higher 90% plus result could be appropriate. But if you do have greater flexibility and willingness to make changes, and you place more value in spending or giving your money while you're still here, then a lower probability of success in the 70s could be appropriate as a starting point for your plan. So first, we establish your baseline retirement plan using our Monte Carlo analysis with an acceptable result based on your preferences. Then we establish guardrails, which, if reached, would warrant a change in your plan. For example, if your baseline retirement plan results in an 83% probability of success, we may set the lower guardrail at 65% and the upper guardrail at 95%. If we breach the lower guardrail, we'll identify spending cuts to bring your plan back into the desired range. And if we breach the higher guardrail, we can identify spending or giving increases. And if you're anywhere in between, no action is necessary. Once we've established these guardrails, we can model the change in your portfolio that, all else equal, would bring your plan to these guardrails. This will give you a precise percentage and dollar figure aligned with these guardrails. This is helpful in quieting some of the potential noise in the market swings. Without this context, you could open up your investment account, see the market down, and then question the soundness of your plan. By identifying ahead of time the precise values that would require action on your part, you'll know the numbers critical to your plan and hopefully be less concerned with day-to-day or month-to-month swings. After identifying the portfolio values that correspond to your lower and higher guardrails, then we can identify the changes that would be required to correct course. This is especially helpful in exploring the negative scenarios, as we can proactively identify how significant a change would be required to your plan. Let's take a closer look at this example. This couple is planning to retire at age 64 with $1.5 million in their investment portfolios. Their monthly spending is approximately $6,000, and they have goals above and beyond that, which include $30,000 of annual travel through age 70, which is then reduced to $15,000 per year. They would also like to start making annual gifts of $10,000 to their children. And lastly, they plan to downsize at age 75 in order to right-size their living situation and free up the equity in their home. This yields an initial 83% probability of success, and it also corresponds to estimated withdrawals that look like this, obviously far different than a fixed percentage withdrawal rate. Next, we explore adverse market circumstances that would breach the lower guardrail of their plan. By adjusting the value of their investment portfolio in our financial planning software, we find that a 14% decline in their portfolio, holding all else equal, would change the probability of success from 83% down to 65%. Then we temporarily hold that lower portfolio value constant and explore adjustments that would move their plan outlook back towards 83%. My default here is not to try to get exactly back to 83%. Instead, we target something in between. The main reason for this is markets tend to correct, and a drastic spending cut is unlikely to be necessary. Put another way, if we've already realized a 14% decline in a well-diversified portfolio, markets have generally declined significantly already, and they're likely to recover. Maybe not next month, but over the next 1 to 3 years. So a modest change to move the plan outlook back in the direction of 83% is likely to have a future tailwind of increasing portfolio values. A few scenarios we run through that increase the plan's outlook include reducing monthly spending by $300, which increases probability of success to 72%, reducing travel from $30,000 to $20,000 a year through age 70 increases probability of success to 73%, reducing travel beyond age 70 to $10,000 instead of $15,000 increases probability of success to 72%, and pausing gifts to children until age 70 instead of starting this year increases probability of success to 70%. And of course, some combination of these adjustments could be a viable option. It's up to the retiree which of these options they'd like to take, but at this point we do select one of these options, and that's our starting point if we reach this lower guardrail. With this, we've identified the magnitude of a decline that would warrant change and the action you plan to take in this scenario. We still can't do anything about what the markets will give us, but we can plan for what is within our control. And then at the upper guardrail, we can also go through this same exercise, although the risk to the upside is not at all the same as the risk to the downside. In these positive scenarios, we explore increases in monthly spending, greater travel budgets, greater giving budgets, and more. So that is a high-level overview of my retirement plan strategy. What I like most about this plan is, first, it starts with a highly customized outlook for your retirement plan, including intricacies around healthcare planning, Social Security timing, and more. Second, it identifies the change in your portfolio where we would act. Everything else can be thought of as noise for your long-term plan. And lastly, and perhaps most importantly, it allows you to proactively identify what you could change to right the ship in an adverse scenario. During market turmoil, there can be a strong desire to take action and exert control. Some people may turn to their investments to exert control in these environments, which is understandable but rarely helpful. So by clearly identifying the action we can manage with our spending, it helps to feel more in control and exert positive control in an uncomfortable situation.